According to portfolio manager Paul Gambles, the Federal Reserve needs to cut interest rates at least 5 times next year to prevent the U.S. economy from entering a recession. Gambles, who is the co-founder and managing partner at MBMG Group, expressed his belief that the Fed is falling behind in cutting rates, and in order to avoid a prolonged tightening cycle, they will need to deliver at least 5 cuts in 2024 alone. He warned that Fed policy is disconnected from economic factors and reality, and it is uncertain when they will realize the damage they are causing to the economy. Currently, the U.S. policy rate stands at 5.25% minus 5.50%, the highest in 22 years. Traders are now predicting a 25 basis point cut as early as March 2024. Federal Reserve Chairman Jerome Powell stated on Friday that it is too early to declare victory over inflation, dampening expectations for interest rate cuts next year. Powell emphasized that policymakers plan to maintain a restrictive policy until they are confident that inflation is heading back to the central bank's target of 2%. However, financial markets interpreted Powell's comments as dovish, leading to new highs in Wall Street's main indexes and a sharp decline in Treasury yields on Friday. The perception now is that the U.S. central bank is finished with raising interest rates. U.S. consumer prices remained unchanged in October compared to the previous month, raising hopes that the Fed's rate hikes were starting to bring down inflation. Veteran investor David Roche also believes that the Fed is done raising rates. He stated that unless there are significant external shocks to U.S. inflation, such as energy or food, it is almost certain that the next rate move will be down. Roche, who correctly predicted the Asian crisis in 1997 and the 2008 global financial crisis, believes that inflation will not be pushed down to 2% anymore and will instead remain around 3%. The Fed's interest rate plans will be revealed at its next and final meeting of the year on December 13. Most market players expect the central bank to leave rates unchanged.